Before numbers, before banks, before the word money even existed, people traded shells, stones, salt, and stories. But how did humans decide that a simple object could represent value? This is the story of how money was born not from greed, but from trust. From the shores of ancient Africa to the palaces of kings, this is how belief became currency. Imagine a world where no one used coins or paper. Farmers traded grain for tools, hunters for meat, potters for cloth. Every exchange required perfect balance, a barter system. But barter had a fatal flaw, what economists call the double coincidence of wants. You had to find someone who had what you wanted and wanted what you had. Without that, trade stopped. As communities grew, barter became impossible to manage. Humanity needed a universal language of value, something everyone trusted. Humans began to give meaning to objects. Cowrie shells, salt bars, beads, stones, things rare enough to carry weight, but common enough to circulate. In Africa, cowrie shells became a symbol of wealth. In the Pacific, polished stones the size of a man were used as currency. In Rome, soldiers were paid with salt. The word salary comes from sal, the Latin for salt. These early currencies had no intrinsic worth. Their power came from belief, the shared trust that this object equals value. Around 3,000 years ago, a civilization in western Anatolia, the Kingdom of Lydia, changed history. They began stamping small lumps of a gold-silver alloy called electrum with the royal seal. These were the world's first coins, a promise from the king that each piece had equal value. Coins made trade faster, trust simpler, and power more centralized. They allowed empires to tax, armies to march, and civilizations to expand. The Lydian idea spread like wildfire. Greek city-states adopted it, then Rome perfected it. The use of metals represents a transition in the evolution of currency. Wherever the empire went, money followed, and so did taxation, trade, and corruption. Coins became tools of propaganda. Emperors stamped their faces on them as symbols of divine authority. Holding a coin wasn't just holding value, it was holding power. Every currency ever created, from shells to silver, relied on one fragile thing: collective belief. People had to trust that everyone else accepted it. The moment trust collapses, money dies. That's why when empires fell, their coins turned to dust. Gold remained valuable, but stamped symbols became worthless metal. Money's true strength has never been the material, it's the story we tell each other. Increasing complexity of transactions highlighted the need for a more convenient and standardized form of money. This need paved the way for the development of coinage and other advanced monetary systems. Coinage was invented to standardize the weight of currency. Coinage was also invented to standardize the purity of currency. Standardized weight and purity made transactions easier. Coinage also made transactions more reliable. Royal mints were established to produce standardized coinage. The royal mint produces coins bearing the royal seal. This seal signifies the state's guarantee of the coin's value. The state's involvement ensures public trust in the currency. The mint's operations are overseen by governmental authority. This oversight helps maintain the integrity and stability of the monetary system. Therefore, the state plays a crucial role in validating and securing the value of coins. Coins facilitate daily transactions in marketplaces. Coins offer a standardized and portable medium of exchange. Their use simplifies the buying and selling of goods. Coins enhance transaction efficiency compared to barter systems. The adoption of coins marks a significant advancement in monetary systems. Coins were instrumental in the evolution of accounting practices. The use of coins enabled more precise financial tracking. Coinage facilitated the standardization of monetary values. This standardization improved the accuracy of financial records. Consequently, coins promoted more efficient financial management overall. Coinage played a crucial role in facilitating international trade. Standardized coins provided a recognized medium of exchange across different regions. This system simplified transactions and reduced the complexities of bartering. Coinage fostered economic connections between diverse cultures and societies. The use of coins helped to establish a more efficient and reliable global trade network. Goldsmiths functioned as custodians of valuable metals. People entrusted their coins to goldsmiths for secure storage. Depositors received receipts as proof of their deposits. These receipts represented the value of the coins held by the goldsmith. This practice laid the foundation for early banking systems. Goldsmiths initially provided secure storage for people's coins and valuables. Depositors received receipts as proof of their holdings with the goldsmith. Goldsmiths realized they could lend out some of the deposited coins, as not everyone would withdraw their funds simultaneously. Instead of physically transferring coins, borrowers could use the goldsmith's receipts to make payments. These receipts began circulating as a form of early paper money backed by the goldsmith's reputation and reserves. Goldsmith receipts evolved into early forms of banknotes. These banknotes represented a promise to pay the bearer in gold. Early banknotes facilitated transactions as a medium of exchange. This marked a further abstraction of money beyond physical gold. Banknotes streamlined commerce and reduced the need for carrying large amounts of precious metals. Banknotes offer enhanced ease of transport compared to coins due to their lighter weight and compact form. The portability of banknotes simplifies transactions and reduces physical burden. Banknotes inherently lower the risk of theft because they can be concealed more easily than bulky coins. This decreased visibility makes banknotes a safer option for carrying value. Central banks are established to regulate the money supply within an economy. A primary goal of central banks is to ensure the stability of the financial system. This stability is achieved through various monetary policies and regulatory measures. These policies aim to control inflation, manage interest rates, and maintain overall economic health. Central banks are responsible for issuing banknotes as a form of legal tender. These banks influence the money supply by controlling the amount of currency in circulation. Central banks also manage the economy by setting and adjusting interest rates. Changes in interest rates impact borrowing costs, influencing inflation and economic growth. Money serves as a medium of exchange, facilitating transactions for goods and services. It enables the purchase of essential items like food, clothing, and shelter. Money functions as a unit of account, providing a standard measure of value. It allows for the payment of wages and salaries to employees for their labor. Money is also used for investment in businesses, fostering economic growth and development. Fractional reserve banking is a system where banks hold only a fraction of their deposits as reserves. The remaining portion of deposits can be used for lending and investment. This practice enables banks to create new money through the process of lending. When a bank provides a loan, it credits the borrower's account, effectively increasing the money supply. The borrower can then use this newly created money for various transactions. Fractional reserve banking plays a central role in modern economies by facilitating economic growth. Fractional reserve banking inherently carries the risk of bank runs. A bank run occurs when a large number of depositors simultaneously try to withdraw their funds. Banks only hold a fraction of deposits as reserves, making them unable to meet all withdrawal demands at once. This inability can lead to bank insolvency and failure. The failure of one bank can trigger a domino effect, causing other banks to collapse. Such systemic risk can escalate into widespread financial crises, impacting the entire economy. Money facilitates transactions in modern financial markets like stock exchanges. In stock exchanges, money is exchanged for shares of publicly traded companies. Bond markets use money for the buying and selling of debt securities. These exchanges of money drive investment and capital allocation in the economy. Money serves as a medium of exchange, facilitating transactions between buyers and sellers. It enables the efficient allocation of capital to productive investments. Money allows investors to pool resources and fund large-scale projects. This investment drives economic growth by increasing productivity and innovation. Money has evolved from simple commodities like shells to complex financial instruments. Early forms of money facilitated basic trade and bartering systems. The introduction of coins and paper money standardized value exchange. Modern financial instruments, such as stocks and bonds, enable complex economic activities. Throughout its evolution, money has consistently served as a facilitator of trade and economic growth. Money is continuously evolving, adapting to technological advancements and changing societal needs. The digital age has accelerated this evolution, introducing new forms of currency and payment systems. Cryptocurrencies, like Bitcoin, represent a significant departure from traditional, centralized financial systems. Digital payment systems offer increased convenience and efficiency in transactions, further transforming how money is used.